This video will walk you through Chapter 5, Problem 5-15 on page 284 in the text. So as you can see below, I've sort of filled out or completed a template. Primary reason for this is to actually expedite the video. I do not suggest you have a similar template when you attempt the questions. However, the format will be very similar. So let's just get into it. The purchase price. In the problem, it tells us we purchased 80% of the outstanding shares of Partridge for 4.12 million. So let's enter in that 4.12 million. Now, just to keep track of things, let's mention at the top here, it was 80%. So in order to figure out the implied cost, what we're really looking for is, hey, how much would it cost if we bought all 100%? The quick and dirty version of that calculation is taking how much we paid divided by the percentage, and that should give us 5.15 million. Next, we will want to figure out the book value of our net assets. Easiest way to find this information is directly from the question. In that question, it gives us a carrying amount and fair value of Partridge. And you can see in the second half, ordinary shares and retained earnings are listed. Reminder that ordinary and common shares are interchangeable terms. So let's just jot this down. The common shares are at 2 million and the retained earnings is 2.5 million. Now, of course, we want to have a sum of these figures, so let's just add that in. So the total net book value of the total value of the net assets were 4.5. Now let's look at the difference between the implied cost and our book value. That leads us to a $650,000 acquisition differential. Next, we want to figure out these fair value adjustments. So you can see that I've listed them directly. It saves us a little bit of work from going through because we've already, if you take a peek at the question, cash and accounts receivable have the same carrying amount and fair value, so we don't even need to bother listing them. In inventory, let's jot this down. We have 2.2 million. Oops. I'm hoping I didn't add an extra zero in the mix, and minus 2 million. Should give us 200,000. Next, it will be the patents. You can see there's a difference just from eyeballing it of 500,000, but for the sake of this example, I want to make sure everybody knows where the numbers are coming from. So we have 1.5 million less 1 million. Of course, I did not put my formula. There we are. Next will be the difference between our 10% bonds payable. So let's take our 3.3 million less our 3 million. Now, as remember, that is a liability. We will just need to change the sign around. So that should be appearing as a negative 300,000. So now let's add up our fair value adjustments. It gives us 400,000. Now we'll need to take the difference between our acquisition differential and our fair value adjustments to figure out what is our value for the goodwill. So we'll take the 650 less the 400 gives us 250. Next, we need to go on to now step 2, which is the purchase discrepancy amortization schedule. This is prepared because not all of our fair value adjustments are, quote, corrected in year 1. Depending on the nature of the line item, it can go through several years. So as we can see here, let's look at our inventory. We started with our 200,000 and it was adjusted in year 1, assuming that they sold it the following year, so it gets sort of cleared out. Patents, a little bit different, started at 500,000, but it tells us in the question that the patents have a useful remaining life of 10 years. So that means that we will be needing to take our purchase discrepancy amortized over 10 years for the patents. So we will have 50K per year. Next is bonds payable. So we have that negative 300,000. That also is over a 10-year period. So we'll take a negative 30,000 per year. Lastly, the goodwill. It is at 250. Now, the only time you have adjustments to goodwill is in the event of an impairment, and it does tell you that there was 2 impairment losses recorded pertaining to goodwill. One was in year 1 for 25,000, and the other one was in year 3 for 12,500. Okay, so now we are ready to figure out our closing balances. For inventory, it will be 0 because we had it in the opening and it completely cleared out in year 1. For patents, we will take our 500,000 less our 50,000 each year. Same thing for our bonds payable. We have our 300 less our 30 for each year. And our goodwill, 250 less the 25 less the 12,500. So our closing final position will be 352,500. Now remember, SANA is our subs adjusted net assets. SANI is our subs adjusted net income. And SOAR is our subs opening retained earnings. So now we're ready to move on to step 3. Now remember, we are completing step 3 because we are approaching this question under the cost method. Of course, if we're using the equity method, we may not have to do this step, especially as it pertains to dividends. But in our case, yes, we are. So the dividends we received overall, that were issued overall was $100,000. Remember that we only have 80%, so we have to capture that $80,000. So next we need to go on to step 4, which is figuring out our income statement non-controlling interest and our balance sheet non-controlling interest. So let's start up with our income statement. We know the subs net income was 200K. We also know the purchase discrepancy amortization for year 3 was 32,500. That will give us our subs adjusted net income of 167.5. Remember, 20% of it is related to the non-controlling interest party. So that means we will have a debit on our books of 33,500. Let's move on now to our balance sheet non-controlling interest. First, let's enter our shares. So common shares, 2 million. Retained earnings, 3.1. Our total unamortized PD is from right here, 352,500. For the sake of it, let's just link it up. That gives us our subs adjusted net assets of about 5.4 million and change. Remember, we take 20% of that because that does not belong to us, and it will result in our adjustment of about 1.1 million. Now we're ready to move on to step 5. Remember, step 5 would not be completed under the equity method because the parent's net income under equity is really the consolidated net income. But as we are doing the cost approach, we do need to make a few changes here. So now we need to figure out the parent's net income. Now we need to be careful with the direction of this, if it's a positive or a negative, because remember, when we use these, it's going to be carried forward to the consolidated statements between debits and credits. So let's make sure that we're showing the income here actually as a negative because it's a credit. So according to the income statement, it looks like they made 474,000. Let's make sure that's negative 474. Now from there, we will want to add 134,000. Where I got this 134 states there investment revenue from Partridge. From that, I will want to deduct 80,000, which is the amount of our dividends. That should give us a negative 420,000. From that, we want to retake away our dividends from our sub, which is 80. Then that will give us our parent's adjusted net income of 340. We want to re-add back in our figures here. Now, you'll notice that its sign will need to be adjusted. This is just a formula hiccup on my side. Why do I need to adjust it? Because remember, net income is a credit. So at 80%, we have the 134, and we're back up to 474,000. This is the same figure that is represented at the bottom of Brady's income statement, 474. Finally, step 6. This is also not applicable if you are approaching it from the equity method. So let's figure things out. We have the parent's opening retained earnings under equity method, of course, is equal to our consolidated opening retained earnings. This isn't really relevant to our calculation, but it's just more of an FYI for you guys. So the parent's opening retained earnings is 6 million. You will not really be able to get this from the existing statements in the textbook, as from this point on it's sort of been edited for cost. If you want to be using this information, or you're trying to figure out where this information is provided, I would take a peek down at the income statement sort of format and some of the templated figures provided, especially for this question. It's just been edited so that you can actually see the difference between cost and equity. Then from there we have our subs opening retained earnings. That would be 3 million. Then we also have less the subs retained earnings at purchase, which we can see is 2.5 million. We have the change in sub, which will be 500,000. Now our past amortization for our purchase discrepancy is available up here. Now it will be a sum of these two columns, so we'll want to do that, plus our 20K from year 2, which will give us sort of a net position of 235. We'll take 80% of that, and we will add our 188 to that parent's opening retained earnings and give us our figure of 6.188. So now we are ready to work on our consolidations. First line item that we want to impact is our dividend income. This was calculated in step 3 and is $80,000. After that will be the patent amortization for 50K. Then our bonds payable is negative 30. Next will be our loss on our goodwill, the write-down of 12.5. Non-controlling interest, as we calculated in step 4, is 33,500. Now our retained earnings will be a very different approach. We are just going to really black out a few of these line items. For our opening retained earnings, we're going to use the figure we calculated in step 6. Then we're going to take our net income that we calculated in step 5. And we just need to factor that we're only capturing the parent's dividends. After this, we want to continue down and hit the balance sheet. So the patents are now going to be increasing by 350,000. Our investment in P shares will be deleted altogether. And our goodwill will now show to 12,500. The next line item will be the 210,000 for the bonds payable, and also the non-controlling interest of 10,500. Common stock and retained earnings will not be present, so we just want to black those out. And instead we're going to be using our common stock now just of the parent and our retained earnings as we calculated above. So that's it, folks. We have a reconciled consolidated statement per the cost method.